So we have some big developments coming down the pike. There's 4 things you need to be on the lookout for and prepare yourself for, and have a plan for what you're going to do and how you're going to react. So number 1, we do know that there are tax changes coming around in the United States as well as abroad. Globally, there's been agreement that there needs to be a global tax instituted. So taxes are going to increase from a global standpoint for companies doing business abroad. In the United States, we have capital gains tax that could be retroactive, and all kinds of corporate taxes and individual income taxes that are going to be on the increase. We have the Fed talking about, well, Janet Yellen came out and said that we would be better off if interest rates were higher, that the markets would be better, the economy would be better if we had higher interest rates. The Fed is now talking about quantitative easing, QE, taking the foot off the gas and tapering to see how that looks. And then we have inflation. Everybody knows that there is inflation. The Fed has been trying to deny it, saying it's only transitory and that it's a temporary thing. And as soon as we get everybody back to work, get through the pandemic, that will stabilize. And I think you all can see it. You can all feel it. We have inflation. It's alive, it's real, and it's not going anywhere. Once prices go up, very rarely do they come down unless they have to. And how do they come down? Deflation. You have to have competition, you have to have oversupply, you have to have less demand. How do you get that? By a deflationary environment. So we have to go down the other side of the road. We've been on a bull run in all of the markets, all of the assets, everything. Real estate, stock markets, cryptocurrencies, everything for the last year has been parabolic. And it's all because of the quantitative easing, the flood of liquidity in the market. So that is going to stop. It has to stop. It can't keep going because it becomes unsustainable. Wages are not keeping pace with inflation. Even the $15 an hour thing, that still is not enough to keep pace with inflation. So something has to give. So we have the perfect 4 storm coming at us that you have to be on the lookout for. And the first place you're going to see it, the first signs are going to be in the markets. Remember, the markets are never wrong. Markets always forecast structural issues within the economy and future things coming down the pike that are going to be a major effect on the economy, have a major impact on the economy. So watch the markets. The Treasury Secretary and the Fed are teeing up each other so that we can have interest rate hikes and quantitative easing, so that we can take the foot off the taper, start doing the taper, take the foot off the gas of the liquidity coming down the pike. So keep an eye out for that. That will play out in the markets. We've got interest rates that are going to be going up. That's going to affect asset valuations. That's also going to increase bond rates, which is going to take the money out of the markets, going to go back into the bonds. And when interest rates go up, the dollar gets stronger. The dollar will be a safe haven, because whenever the economy is struggling, whenever interest rates are on the rise and we are in uncertain times, everybody floods into the dollar as the safe place to be, because you want to be able to take advantage of opportunities when they come down the pike. So you need dollars in order to be able to do that. Everything will be affected: gold, stock markets, cryptocurrencies, real estate. When you get rising interest rates, too much inflation, the Fed tapering, all at the same time, and then you add tax increases and tax policy changes that are not in the positive to the entire picture, then you get big sell-offs in all of the markets. You're going to see demand slow down for assets, for loans, for things like that. If people can't borrow money, they can't spend money. We are a consumption-based economy. We are no longer a production-based economy. We are a consumption-based economy, so it's all based on consumer spending. If consumers don't have credit, don't have equity, and those types of things, they can't borrow money to spend. That's not the best policy, but that's how it works. That's how the economy functions and goes round. So we are in very tricky territory right now, with the Fed talking about tapering, with the Treasury talking about raising interest rates, and the Fed talking about raising interest rates. With inflation and with tax increases coming down the pike, it's going to affect all markets. There will be no safe place to be, except at the end of the day, the dollar. So you want to make sure that you look at your cash reserves, look at your asset allocation. If you are at record highs, it's a good time to go to cash. That's why we are seeing certain markets pair off right now. You're going to see the stock market start to have a little bit of a pairing and tapering coming into this, so that people can build cash reserves to take advantage of opportunities. You'll see bond rates increase, bond yields increase, which is going to increase interest rates. which is going to affect the real estate market. It's going to strengthen the dollar, and then we're going to be through the whole cycle again where things deflate, and then the Fed has to jump back in and do what they do to try to spur the economy and get us going again. So very interesting times ahead. This is not doom and gloom. This is just, hey, be prepared for what's coming down the pike. When you put all four of those things together, you get the perfect quad, the perfect storm, four things all hitting at once. It's going to be very interesting times to see how that affects things and how quickly. So just be prepared. Take a look at your asset allocation. Take a look at your portfolios. Take a look at your cash balances. Make sure that you are prepared to take advantage of opportunities, and that you are also not going to get caught short on assets that are going to be affected first and foremost, which is risk assets. Risk on. Risk assets are the first ones that take a beating when rates go up, and everything else starts to change.